Greetings, everyone, and welcome to FinCity.Tokyo's fourth Global Networking event. My name is Justin, and I'll be your facilitator for today. So part one of today's event will be keynote speeches from IMA Japan and Japan Post Bank, and this will be followed by a short Q&A session. The second part of today's event will be a pitch session for foreign asset management companies that will also be followed by a Q&A session. So now we will begin part one. And as our speakers are presenting during part one, we ask our participants from overseas to type any questions that they may have into the Q&A box in Zoom. These will be answered at the end of part one. Please understand that we will not take questions for these speakers after we close the Q&A for part one, so please get your questions in during these speeches. And also please remember to indicate who your question is for. So with that, we will begin with our first speaker, Shinichiro Shiraki. Mr. Shiraki is the chairman for the Alternative Investment Management Association, or IMA, in Japan, and is CEO and CIO for Akebono Asset Management. He will discuss an overview and recent trends in the Japanese asset management industry, especially in alternative investment. Mr. Shiraki.
Thank you very much. It's my great pleasure to speak at this FinCity.Tokyo Global Networking event today. My name is Shinichiro Shiraki. I'm a chairman of AIMA Japan and CEO of Akebono Asset Management. AIMA, Alternative Investment Management Association, has more than 2,000 corporate members globally. We have headquartered in London since 1990, so it's a 30th year anniversary for AIMA. And our Japan chapter, AIMA Japan, was established in 2001. I have been involved in alternative asset management business, including hedge funds and private equities and venture capitals for the last 25 years. So today I'd like to speak about an overview and recent trends in Japanese alternative asset management industry. First, I'd like to discuss Japanese financial market in general. As you may know, the largest liquid financial instruments in Japanese market is JGB, the Japanese government bonds, which has market cap of about $10.5 trillion. Due to recent monetary policy, the BOJ owns more than, close to actually 50% of JGBs today. Other major market players in JGB market is local financial institutions, such as banks and insurance companies. Offshore investors own 13% of JGBs, which has been doubled for the last 10 years, but still a small sort of a proportion. Although the corporate debt market have been growing recently, the market is still relatively small, and US dollar of 600 billion with 3,351 names. There is still small high yield below BBB rating markets in Japan, but we see some potential at the size of Japanese loan market is dollar of 1.3 trillion, 1.6 trillion, and it has been growing due to current environment. In terms of local real estate market, the real estate in Japan is large, estimated size of the 24 trillion US dollar. However, public REIT, Japan REIT market owns less than 1% of those properties, which is about 200 billion US dollar. There are a few local emerging managers in infrastructure market, but it is still small market, and most of the funds only own mega solar infrastructure. Equity market is most active in Japan. There are 3,700 listed companies with 6 trillion US dollar total market cap. That compared to US, of course, the average market cap of each company is very small, and we are facing succession issue in many of those companies. In Japan, we have local alternative asset managers, such as hedge funds and buyout and venture capitals. Unfortunately for AIMA Japan, which represent, of course, in the hedge fund industry here, hedge fund market in Japan is not growing that much for a number of years, but buyout and venture capitals have growing very fast recently. Let me show you some graphs here. So as you can see in the graph, the Japanese private asset have been growing for the last 2 decades. The number shown could be underestimated, as this data provided with the breaking would cover probably almost half of the market. So it could be double. And this you can double estimate this graph numbers. So since 2000, Japanese private asset market, especially local buyers and venture capital, have grown and raised the capital mostly from Japanese investors locally, local Japanese investors. But recently, for the last probably 4 or 5 years, the buyout funds, especially local buyout funds, successfully raised the capital from global investors, endowment and other family office, and those type of investors from globally. So we see here actually the higher number in 2020, even in this the COVID environment. The Japanese market is mostly driven by investors, as you all know. And the most of Japanese investors invest into rather global managers rather than local managers. So this graph shows the investment amount for global managers raising capital from Japanese local institutions. So this blue bar, light blue bar, shows here the number of capital raised by the global managers from Japan. Of course, in local capital, investing to the local managers, which has obviously the home country buyers, that the market of the US and Europe is much larger than Japan. So are those investors investing to the global markets. If we look at the hedge funds market, hedge fund has been stable as the total number of assets and also the number of managers. Since the 2015, we haven't seen much growth here. However, this is a large market, and compared to the global the hedge funds numbers and the assets, the Japanese hedge fund managers are very small yet. I'd like to show a bit about the history of Japanese hedge fund industry. The hedge fund industry in Japan has emerged in 2001. The Japanese hedge fund industry mostly investing to the long short. Strategies are mostly long short equity. 2004 and 2005 was the year for Japanese hedge funds. The many Japanese equity long short managers recorded very good performance, mostly because they long small mid caps and short large caps. So 2006 and 2007, most of the small mid long managers made large losses because of after the life door shock, and the Murakami-san was arrested and late. So that's the small cap and mid cap market has shrunken, and most of those long short equity manager lost a lot of capital. That short-term trading managers were good, but the number wasn't that much. After 2008, 2009, the Lehman crisis, event-driven managers and activist managers emerged in Japanese market. There are a few, but some major arbitrage, the risk arbitrage managers will exist. In 2012, Abenomics made changes Japanese equity markets, and there are more activists and long-short equity managers recorded the good performance or stable performance. But value managers, including the funds manager, recorded poor performance after that. I'd like to highlight lastly the venture capital market in Japan. So I'd like to show the performance of venture capital, the local venture capital. It's very good. If you look at the benchmarks of the Japanese venture capital, the most of managers maybe are really good return, high return, and multiples. So I'd like to say that it will be the year for Japanese venture capital's margin. So I believe the private market in Japan in general will be growing significantly for next decades. So there are a lot of succession issues and carve-out from large conglomerates providing buyouts opportunity. And also we see Japanese unicorns emerge, which provide a great opportunity for Japanese venture capitals. So having said that, I'd like to close my speech by saying thank you for your interest in Japanese market.
Okay, Mr. Shiraki, thank you very much. And as a reminder to our participants today, if you have any questions for either of our speakers during this part of the session, please type them into the Zoom Q&A feature. And remember to let us know who your question is for. So our next speaker is Suguru Azagami, and Mr. Azagami is Director of Japan Post Bank's Private Equity Investment Department. He will be covering recent trends of asset owners in Japan and expectations for foreign managers in his speech today. Mr. Azagami?
Thank you for your introduction. So, hi everyone, my name is Suguru Azagami. I work for the private equity team at Japan Post Bank. And today I'd like to talk about two things. So it's all about my personal view on opportunities in Japan for overseas private equity managers. And also I want to touch upon how overseas asset managers can help Japanese asset owners to develop their global investment activities. So before that, let me briefly introduce Japan Post Bank and my background. Japan Post Bank manages $2 trillion on its balance sheet, and our source of capital is Japanese people bank saving. And the company used to be a state-owned government agency, and it was privatized in 2007. And the company got listed on the Tokyo Stock Exchange in 2015. So until then, the company used to be a passive investor, mainly investing in government bonds and corporate bonds. But the company took a big leap toward building more profitable portfolio by adding new asset classes, including alternative investment assets. So at our private equity team, we started our program since 2016, and it's now like 4 years since we started the program. And we invest in multiple strategies at our private equity team. We invest in buyout, venture capital, infrastructure, and some credit type of investments like mezzanine and distressed. And some unique feature about the company is that although the company has a bank in its name, we are not a commercial bank because we do not do a commercial lending business. So at the time of privatization, we agreed not that we will not enter the commercial lending business in response to concerns raised by other private banks from antitrust perspective. So what we do is to invest our capital into multiple strategies. So just a little bit of my background. I joined Japan Post Bank in 2018, and before that, I used to work for Mitsubishi, which is a Japanese conglomerate company. So at Mitsubishi, I spent a lot of time for real asset investment, including aircraft leasing and infrastructure. And I was also involved in some strategic initiatives for technology investment activities. And at Japan Post Bank, I manage our venture capital LP investment practice and our global VC portfolio. So in our VC portfolio, the biggest exposure is in the US market, while China is second biggest. And we also invest in a few select number of managers in India and Europe. And we also have another dedicated program for Japanese domestic VCs. So on to the main topics, I'd like to talk about two items. So one is about potential for the Japanese private equity market for foreign investors. And the other is about how I think overseas asset managers can help encourage Japanese asset owners to invest globally. So just Shiraki-san briefly mentioned, I think the Japanese private equity market has been growing, but not as much as expected from my view. The Japanese economy is still third largest in the world, so I think the potential is huge. But one of the biggest challenges is that there has been an inherent negative impression against financial buyers. So private equity funds were often called vulture because people thought those funds were only looking to buy out distressed companies to restructure and make money out of them. So still, there are many business owners who think private equity firms as vulture. So buyout deal sourcing takes time because you need to build trust with such business owners. It is especially challenging for non-Japanese to navigate the complex local business culture. So at global private equity franchises in Japan like Bain and KKR, investment activities are led by local professionals. But despite those challenges, we are seeing growing interest from overseas private equity firms. Recently, Blackstone and Apollo are building local teams, and I think it is very encouraging for the Japanese economy. And I believe there should be more investment opportunities given the size of the economy, and private equity would be a great catalyzer to develop the Japanese industries. So in order to accelerate the market expansion, I think it would be even more helpful if the government can work with the financial sector to change the negative perception toward financial buyers. So there will be more business owners willing to work with private equity managers to grow their businesses. And another challenge is that investment professionals are scarce in the market. As I alluded to, attractive investment opportunities are still limited, which is part of the reason for the scarcity. So I hope overseas managers will hire more local people and nurture them as investment professionals. I believe this is particularly important in light of leveraging the limited pool of young talents among the highly aging population in Japan. So in my view, the compensation structure of global investment management companies is sophisticated to align incentives of employees relative to traditional Japanese companies. Seniority still matters in those companies, and it will take a long time to change such organizations. So we need more professional firms which encourage talents to perform to their fullest potential with the right incentives. So the next theme I would like to talk about is the challenges for the Japanese asset owners to build and manage global alternative investment portfolios. I can never emphasize enough that there are not so many investment professionals with a strong financial background and cross-border business experiences. In this regard, I think a local representative of an overseas asset management company to be critical to fill in the gap between Japanese asset owners and global markets. Having more international asset managers based in Japan would be very helpful for potential clients to communicate and build understanding of your products. So with limited resources of individual pension funds and regional banks, it will be very challenging for them to go out to build relationships with investment managers. So I believe there will be a good potential for overseas asset managers to develop businesses with such asset owners by having a local team. So in summary, expectations to overseas asset managers are high, and I hope Tokyo will be an attractive home for more international players. So thank you so much for having me today.
Okay, Mr. Azagami, thank you so much for your speech. And now we'd like to go into the Q&A session. So for the first question, we have a question from Steve, and I believe this question, since it's about the Japanese government funding, may be more appropriate for Mr. Azagami to answer. But the question is, if the Japanese government is funding its companies leaving China, how does that affect Japanese investment positions there?
So just to clarify, so the question is about what if you invest in Chinese companies and also want to invest in Japanese companies? Would that be correct?
I'm not sure, but if you could just speak a little bit on the Japanese government funding Japanese companies who are leaving China, how that might affect Japanese investment positions.
Sorry, I don't know the particular example for that, but I think it's pretty important.
Okay.
Sorry? Could you say that again?
Oh, no, sorry, go ahead.
Yeah, so the government relationship between China and Japan is often very fluctuating in my experience, and I think I cannot give a clear answer, but there is no clear guidance from the government, and I'm not sorry, I think yeah, I think it's one of the things we should kind of carefully monitor, but I'm afraid I cannot give the right answer here.
Okay, all right, thank you very much. And we have another question for you. Would you consider creating a co-GP venture with a foreign GP to facilitate investment in Japanese startups?
Yeah, I think it's a pretty interesting question. So I understand this question is for Japan Post Bank, and if here we have any interest in building our own GP to invest in Japanese startups. Actually, we have a subsidiary company named Japan Post Investment Corporation, and they do the direct investing in Japanese startups. And the Japan Post Bank is LP, and the Japan Post Insurance is another LP. So we are already working on the investing activities for Japanese companies. And but what we need to be careful is that I invest as an LP into Japanese VCs, so we need to be careful about potential competition with between Japan Post Investment Corporation and our GPs. So we very carefully handle information, and I think so. In that sense, it's not very straightforward for us to be a GP and compete with other Japanese VCs. I hope that answers to your question.
Okay, thank you very much. The next question is for Shiraki-san. So what would you expect from foreign asset managers? Could you elaborate a little bit more?
Sure. If possible, we'd like to have more set of our foreign asset managers coming to Japan, meaning located here in Japan, then trading and managing asset from here. So recently, Japanese FSA, our regulators, setting up the one-stop service center in English, so where the foreign asset managers can register, then have a monitoring from Japanese regulators in English. So it can help. And also, their FSA just provided their a tax the reform for foreign asset managers, especially. And it could be helping for the managers to come to Japan and locate here, then trading. We as a Japanese and the Tokyo the hedge fund industry welcome the people coming here in Japan and the trading firm here, which could animate the Japanese industry, so financial industry more.
Okay, thank you very much. Azagami-san, would you have anything to add to that? So in terms of expectations from foreign asset managers, you touched on this a little bit, but is there anything you'd like to add?
Yeah, so we want to see more Japanese working for financial sector as professionals. Japanese local asset managers are more like a Japanese traditional company. So as I mentioned briefly, I think the incentive scheme can be more developed, And I think foreign asset managers are more advanced in that regard. So I hope overseas asset managers can import their culture and incentive structure to Japanese industry so that more talents are willing to work in the financial sector.
I'd like
Okay.
to add one more
Sure,
thing.
sure.
So, yeah, as I mentioned earlier, the Japanese market is more driven by the Japanese local investors. Then the Japanese investors, want to more option to invest in the variety of asset classes and a variety of strategies. Then those people really sort of want the foreign asset managers located here in Japan, easy to communicate and are having better disclosure. So from that point, so we like to encourage the people coming to Japan more.
Okay, sure. Thank you both very much. So we have an additional question from Bernard Lee. And I'd like to pose this to both of you, but if Shiraki-san can answer first. What is the minimum track record required by a Japanese financial institution to invest in a foreign asset manager newly registered in Japan? This is assuming that they have a track record from somewhere else. How long would you expect a new registrant to be in Japan before you will allocate funds?
Yeah, it will be difficult, and also it will be really depending on the situation. But in general, the financial institutions, like for example, like pension sponsors and the gatekeeper, they like to see the 3 years track record in minimum for the hedge fund type of managers. And also the private equity fund and venture capital type of people. I think they need to show probably at least first or second fund sort of a performance in general. That's a kind of a general theme. However, of course it depends. If those the managers are very seasoned, and that if those even an emerging manager which have their past track record, which had experience in the large institutions or other hedge fund companies, I think there would be the kind of exemption for those track record things. That's my experience.
Yeah, so for Japan Post Bank, as Shiraki mentioned, we do not have a defined period of time we want to track. But basically, so if we want to invest in Japanese companies, we look at the team and to understand who can source and execute transactions. And I think we need you need a local team deeply connected in Japanese industries to make an investment in Japan. So if you're going to build your first fund with Japanese local peoples, we look at track record of your Japanese team. And if you're talking about having a Japanese office to attract your LP investors to invest in your international investment funds, we look at the track record of their previous funds, and basically, even it might be the second fund. If your first fund is performing pretty strong, I think we will be attracted to look into more details about that opportunity.
All right, thank you both so much for your responses. And with that, since there's no more questions, we're going to go ahead and close the Q&A session. So thanks again for the speeches and for responding to the questions. So now we will move into the pitch session for the foreign asset management companies. And we have 5 companies pitching today. During the session, we'll be accepting questions via Zoom's Q&A feature. So please type your questions into the Q&A feature and let us know who your question is for. Each company today will be given 10 minutes to pitch. And in the interest of fairness to all companies, we will do a stop at 10 minutes. And we ask for your help in managing our time today. So with that, I'll hand over to our first company today, Algebris Investments. Okay, so Algebris Investments does not appear like they're here yet, so we'll move on to number 2, Blue Elephant.
Thank you. Can you hear me?
Yes, we can hear you.
Oh, great. So you have it up here. Should I, or do you want me to pull up the presentation here? Or
We can go through the slides for you. It's no problem.
Okay, great. So thank you very much. Really appreciate the opportunity to speak to you all. My name is JP Mara. I'm the co-founder and partner and CEO of Blue Elephant Capital Management. We're based in Irvington, New York, which is about 20 miles north of New York City, right on the Hudson River. We started Blue Elephant in 2013 to focus on small balance, short duration, high yielding, niche private credit, both commercial and consumer. And you can go to the next page. Let me just start out by saying that as a group of primarily fixed income institutional professionals, capital preservation is always the first priority in terms of our investment process. You can flip to the next page. So what do we do and how are we unique? Over the last 8 years, we've developed an infrastructure, Blue Elephant, that allows us to not only provide capital for the purchase of leases and loans off of upstart specialty finance company balance sheets, but we also provide other valuable resources to those same companies, including underwriting models, predictive machine learning decisioning, as well as servicing capability and other operational support. You can move to the next page. As I mentioned, we deliver a broad set of resources to our partner lenders, and in return for delivering those array of services, our investment team is then able to negotiate long-term loan purchase agreements with these same lenders. And we're also able to often gain participation in either equity warrants or preferred equity of those companies. And in that way, we're able to not only benefit from the high yielding lease and loan flow that we purchase, but also from the equity opportunity and the upstart of these upstart companies. You can move to the next slide. So these small balance markets are generally pretty complex and not standardized. So they require quantitative overlay, and the quant overlay that we've been able to develop over the last 8 years with our machine learning and our integrative modeling has allowed us to bring an entirely different level of predictive engineering to these fragmented lending markets. You can turn to the next page. So where do we focus? We focus on niche specialty originators who generally originate less than 250 million per year. So they are pre-securitization type originators in size. We focus, as I said, on the small balance lending market. So our funds contain thousands of loans, generally in size anywhere from just a few thousand to upwards of 250K in size per loan. Our markets that we focus on are all very fragmented, where scale is generally very limited. So the big banks and the big private opportunity credit funds don't play where we play, and as a result, there's a lot of good risk reward and high yielding opportunity. Everything we do has to be data supported, so we only go into markets where we have data that can support the diligence that we need to do to get over the line with those originators. Most of what we do has a unique payment profile, meaning we have a unique waterfall characteristics and unique payment characteristics. And then, as I said earlier, the opportunities that we pursue are all short duration in nature. Right now, our portfolio duration target is that of less than 2.5 years. You can go to the next page. So the partnerships that we've created over the last few years in particular has driven a very large investment pipeline here at Blue Elephant. Our long-term goal is to deliver this highly selective, high-yielding, diversified group of private credit opportunities into a global investor base. And our forward investment origination now is likely to exceed, starting in 2021, north of 150 million for the next 2 years, and then probably be closer to about 300 million annually 3 years forward. And our goal is to diversify beyond our US investor base. So in 2021, our investment pipeline is pretty well funded. It is going to be funded primarily by US institutional, family office, and high net worth investors. But in 2022, our goal is to bring this unique asset management platform closer to Asia by establishing a Japanese office and team, and to not only continue to focus on the dollar markets, but we think that we could bring this platform and this template to the yen markets as well, and also to some of the non-Japan Asian markets also. If you could just move to the 10th slide, that would be great. So we, Ashish Jain, Kent McWilliams, Jason Herman, and myself, we make up the senior investment team. And what I would say about the team at Blue Elephant is that our individual skill sets are not only deep, but they're very complementary given our backgrounds. You can move to 11. You can go to the next slide, that would be great. So here's where we are currently invested. We are currently invested in 8 different lending verticals across about 11 or 12 different origination partners. And the net yields across these origination platforms are quite high and quite diversified. And the focus has been on secured opportunities. So about 70% of what we do right now is secured. A good portion of what we do as well, we have 2 verticals that are where the end payor is a government agency. So whether that be Medicare, which is a large payor in 2 of our verticals, and then on the disaster relief side, we have FEMA, which is the government disaster relief agency. Our biggest vertical right now is our secured commercial equipment vertical, and that is short duration used yellow iron or construction machinery loans against construction equipment and dump trucks. And then we have a large secured consumer vertical, and that's anchored by our recreational fishing boat lending and our secured towable RV lending. Those 2 verticals in particular, very small balance. You're talking about $15,000 to $20,000 loans, and average coupon on those loans in the close to the mid-teens. And then if you go to the last page, page 12, you can see what we have in diligence. So our forward investment pipeline, if you take our current verticals combined with these 4 additional investments that we have in diligence, being general commercial equipment, farm equipment financing, U.S. government conservation contracts, and U.S. government CMS receivables, which is where Medicare is and Medicaid are the debtor. Our forward pipeline is somewhere between 500 million and $1 billion over the next 3 to 5 years and growing. And we feel like there's a very complementary growth to be had by moving into the Japanese market, both on the dollar investment side as well as on the non-dollar side. And so we look forward in 2021 to continuing to work toward moving into the Japanese market and establishing a presence there, and then ultimately taking that platform into Asia. I'll stop there. Thank you.
Okay, thank you so much for your presentation. Okay, so our next presenter will be Hosking Partners.
Good afternoon, and thank you very, very much for giving us an opportunity to talk to you today. So not to overrun my time, I am going to run through very few slides, but what we will do is we'll make a more comprehensive deck available so that anybody who's interested can actually read a little bit more. My name is Jenny Buchanan. I'm one of the founding partners of Hosking Partners. Hosking Partners is a fairly new business. We opened our doors in 2013. However, we have a much longer history of managing global equities than this start date may suggest. And we essentially all broke away from a much larger asset management firm in London at the end of 2012. Could we move to the next slide, please? Hosking Partners prides itself in being different, and I'll try and explain our main points of difference to you. We are an owner-managed boutique based in London. We do one thing only. We manage global equities for institutional investors, and our goal is, it's deliberate that we have one product only because we believe all our best ideas should go into that one product. And in order to align our interests with those of our clients, we charge a low base fee plus a performance fee. So we only do well if our clients do well. Currently, our AUM is about $8 billion US, and our clients are largely pension funds and endowments from many parts of the world. And we are very happy to report that we do have one large pension fund client in Japan. We're a small business. Our total staff complement is about 20 people. We have 5 portfolio managers who comprise our entire investment team. The backbone of our investment process is what we call the global generalist multi-counselor system. And this is really based on 2 core beliefs. The first of which is that we believe individuals make better investment decisions than a group, because group dynamics can often get in the way of good investment decisions. And secondly, we think the broader the opportunity set that each PM is presented with, the better they are at spotting good investment ideas wherever they occur, wherever in the world and in whatever sector. So the way this works practically is we would take our $8 billion of assets, divide it into 5 slices, and each of those 5 portfolio managers is given full autonomy over management of his slice of the assets. So what this means is that each of the PMs comes up with a fairly diversified portfolio of about 100 stocks, which when combined into the product that our clients get, actually has approximately 400 shares. Sorry, may I ask you to move to the next slide? Sorry, I'm on slide 2. I can't actually see the slide. So, so we have a very diversified portfolio of over 400 shares. However, somewhat counterintuitively, we have a very high active share of over 80%. And the active share of the underlying 5 portfolios is actually closer to 90%. So our portfolio is not concentrated at the level of the individual stock, but it is rather concentrated on a few big ideas, or what we like to call mental models, that have evolved over many, many years that our team have been working in global equities. Another distinction we believe is that in a world where portfolio managers now tend to turn their portfolios over quite frequently, we have a holding period of about 10 years. So we tend to do things differently, and we believe that makes our portfolio highly complementary to more concentrated portfolios. Could you move to slide 3, please? Our diversified portfolio is, however, very unfashionable at this time. But we believe that's a factor that is likely to make our approach more successful rather than less successful. And in the chart, you'll notice that over the past 15 years, there's been a marked trend to more concentrated portfolios, with most portfolio managers now showing a preference for portfolios of less than 50 shares. So our highly diversified portfolio is just a natural outcome of the global generalist multi-counselor system that I have described to you. And we think this low stock specific risk is what gives us the ability to do things very differently. Firstly, we are genuinely an all cap asset manager. We have no problem investing in smaller cap shares. Secondly, we are able to buy riskier ideas that we think have greater upside potential. We think a feature that is likely to be of interest to large institutional investors is that this approach gives us probably far more investment capacity than you would find in more concentrated managers. And we think we have less capacity constraints because of our very diversified portfolio. If you could move on to the next slide, please. So I don't need to really tell anybody this, but you will all know it very well. But over the last 10 years or so, growth managers have outperformed value managers by a very wide margin. We have faced this situation before, but probably not for as extended a period as we are seeing at the moment. But because we are a patient long-term investor, we have stayed true to our contrarian approach and our strict valuation discipline. We believe that the greatest source of investment risk is actually buying into securities at the wrong price. So as you will see, on the basis of multiple valuation metrics, the value characteristics of our global equity portfolio have become very pronounced over recent years. And although we do not consider ourselves a pure value manager, and we are most often described as eclectic, at the moment, we possibly look more like a value manager than many true value managers. And we think one of the reasons for this is that because we have such low stock specific risk and in our diversified portfolio, it's actually easier for us to buy into riskier, cheaper ideas than a concentrated manager might be able to do. So the biggest overweight positions in our portfolio at the moment are banks and emerging markets, and our largest underweights are to the US and to the IT sector. If you could please give me slide 5. So just to tell you a little bit about how we have behaved in 2020, we have certainly embraced the approach of never letting a good crisis go to waste. And what we have been doing is selling stocks that have done very well, the Amazons, Microsoft, and other tech stocks. We call those the COVID beneficiaries, and we've been buying into COVID casualties, stocks that have really been hammered by the pandemic. And the prime examples there are travel, entertainment, and shipping. We've also been buying what we call dinosaur disruptors, although we have been doing this for quite some time. And we describe dinosaur disruptors as old economy stocks that we believe are doing a very credible job of converting to the new tech era. Examples of our dinosaur disruptors are the big banks. We think the banks are priced at very, very attractive levels, and in many instances we believe they're priced virtually as if they're going out of business. But we don't think the banks are the problem at the moment. We think the banks generally are pretty well capitalized, and we think the banks have a lot of capital to throw at their technology platforms. And indeed, we believe COVID has probably fast-tracked the degree to which the traditional banks have moved and improved their platform offerings. So you'll see the chart on the right-hand side there, where we're comparing the price chart of Disney and Netflix. And Netflix is what we call a dinosaur disruptor. And you will see that, Disney is the dinosaur disruptor, and Netflix has outperformed Disney by many orders of magnitude over recent years. But we think that Disney is probably a very, very credible competitor in the streaming space. They have a vast amount of content at their disposal, where we think Netflix possibly has to spend a lot more capex developing its content in order to keep its subscribers happy. I think in the few months that Disney has launched Disney Plus streaming, they have approached nearly 100 million subscribers. So in terms of how Netflix is valued and how Disney is valued, we'd prefer to put our investors into Disney. And one of the things we do like to mention is Mickey Mouse has never asked for a pay rise.
Hi, Jennifer. Thank you for your presentation. Can I ask you to take about 1 more minute to wrap up?
Sure. So what do we believe that Hosking Partners has to offer? So as a small boutique based in London, our aim is to try and find a partner with whom we can work in the Japanese market. And this could perhaps be a bank or an asset manager who would see us as a useful diversifier in their global equity portfolios. We believe we are decidedly different, and our stock-specific risk and long holding period are what allow us to do things very differently. So we would welcome a few opportunities with a few potential partners in Japan. And thank you very much for your time.
Okay, thank you very much, Jennifer. Okay, so now we'll move to our next company, True Crowd Inc.
Okay, hello everyone. My name is Vincent. I'm with True Crowd Inc. We are based in Chicago, Illinois suburbs. As of now, we are regulated by the SEC as a funding portal. Basically, I think it's a known crowdfunding in general, equity crowdfunding. In fact, investment crowdfunding. And our next goal right now is to help companies from Asia, and we'll start with Japan, to give them access into the US capital and US consumer market. Next slide, please. So we think it's a big opportunity to bring companies, mostly, I would say, early stage with some traction. So we are looking for, in general, startups that they prove their concept in their local Asian market. And the opportunity is there because US economy, it is big and vibrant. Next slide, please. Also, there are lots of investors. Through what we do, equity or investment crowdfunding, it is very similar with retail investments. That means anyone can invest as little as $200, $300. So small amounts from lots of people. And clearly, US and North America, they have the investors needed to be successful. Next slide, please. We think we solved the problem that in general, companies, startups, Asian companies from at early stage, they have limited access to capital. Then, if they would like to enter the US market, they need support. We will provide both support. Next slide, please. So we'll provide both support from compliance perspective, being a SEC regulated FINRA member funding portal, and we will help the companies with everything they need to be able to raise the money and develop their future market here in US. Next slide, please. As I said, we are already a funding portal. At this point, the maximum amount a company can raise it is $1 million. However, the SEC, they already changed the rules, and probably 2 months, 3 months from now, for regulation crowdfunding, this is the, I would say, the entry level regulation that we would apply, the limit would be 5 million. And then for companies that 5 million is not enough and they need more, and they also have the traction to be able to raise more than 5 million, there is a second regulation called the Regulation A+ or mini IPO. And for that, we will be able to raise up to $75 million. Also, we will provide access to our network of different providers, marketing, and everything that is needed for the company that will enter into the US market. Next, please. We are not a solution for everyone. We look for mostly, we think that consumer-facing B2C companies are a better fit because crowdfunding will allow easier way to explain to retail investors why they should invest. And again, another criteria for the companies that want to enter the US market is to have a proven business model in their local market. Next, please. Our business model, how we make money for regulation crowdfunding, the one that will be up to 5 million very soon, we charge a success fee between 8 and 10%. And for the other, we have a flat rate for transacting the security. Next, please. At this point, we are planning to grow. We just finished the consultation with Ernst & Young to launch a Japanese crowdfunding portal. Then next year, we'll apply to become a broker-dealer under the SEC, US SEC regulation. And then with that, we will be able to create a secondary market for the crowdfunding investments that will happen through our platform. And at the end, we will open at the end of the year, we will open throughout Europe, because there is a big potential there too. Starting November next year, probably the crowdfunding regulation will get harmonized and will be one regulation for all the states, all the countries in the European Union. By doing that, we'll have what we do right now with the US market. We will be able to take companies from Asia and open them access into the European market eventually. But for now, it's just the US market. Next, please. Because we grow, we need, we will raise money, and we will raise money using what we know the best. So first quarter 2021, we will start our raise of $5 million in the US regulation. And then in 2022, we will need more money, and we'll raise more money for ourselves using the regulation A+, the mini IPO regulation. Next, please. We are looking for partners in Japan, and we will talk to anything that will be interesting. Thank you very much.
Okay, Vincent, thank you so much for your presentation. And just as a reminder, anyone with questions, please use Zoom's Q&A feature to ask your question, and please let us know who your question is for. So now we'll move to the next company, Vertex Growth. Turn it over to you, Vertex.
Sure. Should I be sharing the screen?
Oh yes, please share your screen with us.
Okay, no problem. Can everyone see it?
Oh yes, we can see it and we can hear you fine. Thank you.
Great, perfect. Okay, good afternoon, everybody. I'm James Lee, Managing Director at Vertex Holdings and also Managing Partner of Vertex Growth. First off, thank you for the opportunity to speak to all of you. I'll be introducing the Vertex Group and the Vertex Growth Fund. So Vertex Holdings is a Singapore-based venture capital holding company. We provide anchor funding and operational support to a proprietary global network of venture capital funds. Today, we operate 6 network funds comprising more than 90 investment professionals distributed in the key innovation ecosystems globally. And in aggregate, we manage more than $4 billion on the platform. And we've invested in more than 200 active portfolio companies today. This is the current structure. Vertex is one of the oldest venture capital firms in Southeast Asia. And we have a very long-standing relationship with Temasek, who is our anchor sponsor. Alongside Temasek, we also manage capital from various Japanese institutions. The logos are shown on screen. And we manage that through a fund structure that we call the Vertex Master Fund. The Vertex Master Fund also allocates capital down to the network funds that I mentioned earlier, the 6 network funds, and it's shown on this chart. And we invest across technology as well as healthcare across the 6 funds. We invest across regions. You would see that we have technology funds, focusing on China opportunities, Israel, Southeast Asia and India, as well as the US, with local investment teams. And we have a dedicated healthcare team investing in the biotech and medical device opportunities, and the Growth Fund. Each of these funds is anchored by Vertex Holdings, but they also raise external capital, with the exception of the healthcare fund for now. And we also invest across stages. The early stage funds focus on Series A and Series B. And we have a Growth Fund, which I'll talk more later, that focuses on the later stages of Series C, D, and onwards. So on this platform, I think what we're trying to do is to develop a capability that's able to tap into global innovation, but to anchor the investment capability locally, because we believe that for VC investing to be effective, we need to be close to the ecosystem. On this chart, it shows the various geographies that we operate in and the most pertinent investment themes in terms of technology innovation that each of the funds have in their investment mandates and thesis. We have a long operating history, and we've generated multiple unicorns to date, and other notable exits as well, as shown on this slide. At Vertex, we also believe in building a very close and tight Vertex innovation partnership ecosystem. We seek to bring value beyond capital returns in terms of insights, opportunities, connections, and innovation ideas to our stakeholders who invest in us. Now moving on to the Vertex Growth Fund. As mentioned earlier, the Vertex Growth is one of the 6 funds on the Vertex platform. And this is the fund that focuses on follow-on opportunities in growth stage companies that have demonstrated strong traction and potential. We typically invest in companies that are revenue stage. They have crossed the technology and product risk hurdles and have proven good product market fit and are raising capital to scale their growth. The reason why Vertex Growth Fund is interesting is because as part of the Vertex network, we have privileged access to our sister funds portfolio. These funds are early stage funds, and they typically invest in Series A and B, as mentioned earlier. What we have seen in the past before we set up the Vertex Growth Fund is that as some of these promising portfolio companies scale through the stages, the early stage funds are not able to continue investing beyond a certain point as they reach their portfolio cap. And as a result, many promising portfolios have not been fully funded, and the upside has been missed. As an example, I think most would be familiar with this company called Grab, the largest ride-hailing company in Southeast Asia. This was a company that was invested in Series A by our Vertex Southeast Asia Fund, and they continued to follow on in Series B and C. And back in 2014, the Vertex Growth Fund was not yet set up. And naturally, with the Growth Fund thesis, if we were set up back then and were able to participate in the Series D, given where the company is in terms of current valuation, we would have been looking at a 12x multiple return. And these were the kind of opportunities that triggered us to set up the Growth Fund. So with that, the Growth Fund was actually launched in late 2018. We started investing in 2019. This is a $219 million US fund. We actually exceeded the target fund size of 250. Currently, we have invested 40% of the fund, building a portfolio of 12 companies, of which 5 were led by Vertex Growth. 1 has already been listed, and 4 of them have gone on to raise subsequent rounds at valuation upticks. The mandate of the Growth Fund is really to invest in growth stage companies, primarily focusing on the pipeline from the sister funds that I mentioned earlier, the early stage sister funds, and that represents a really strong pipeline of over 200 active portfolio companies. But outside of the Vertex pipeline, we also have 20% of our fund reserved for external investments as well, so we are not captive to Vertex opportunities. And our typical investment ticket size is 10 to 20 million per company, and we can invest up to 15% of committed capital in a single portfolio company. This is a quick update on the fund performance to date. As you would note on the top left, we have deployed 40% of our fund. Investment cost is about 102 million, and the NAV right now is at 126, giving a 1.23 times multiple as it stands to NAV, and gross IRR of 25.6%. As you can see on the top right-hand corner, that represents the pipeline, the pipeline that Vertex Growth Fund has been working on, which has been really rich. And we've invested in 11 companies that are from the Vertex portfolio and 1 company that's outside of the Vertex portfolio. And there's a really good representation of interesting companies that spread across geographies, as well as the key innovation and technology themes. This is a slide to show the progress of the portfolio to date. On the horizontal axis, and to note, it's not a linear scale, it's kind of exponential. The companies that we've invested in the 2019 vintage, and in fact, the earlier half of 2020 have continued to progress well and have increased their revenue run rates significantly. Some of the portfolio companies like Verbit and Endogastric Solutions were more recently invested, and we believe with time, they will continue to scale well as well. For the healthcare companies that we invest in, Bicycle and Nuvera, they are not revenue stage. They're still at clinical development. And when they get FDA, that's when they become commercial. Hence, they're not represented on the revenue curve. This is one slide to indicate our progression in terms of the typical venture fund J curve. On the vertical axis is net IRR, and you can see that with the green and red lines, these are our typical benchmark J curves for with data sets coming from Cambridge Associates for the green line, as well as other data sets for the red line. And you can see that the important thing is in the first few years, typically for such funds, they will run into negative IRR because the portfolio hasn't had time to accrue value while the fund is drawing down on management fees. But the growth fund has actually seen significant value inflection even just in our second year of inception. And we've actually gone into positive territory in terms of our net IRR within the second year of inception. One of the key advantages of the growth fund really is being a member of the Vertex family. We have unparalleled and very privileged access to the majority of the pipeline, as mentioned earlier. We have direct access to the portfolio companies of our sister funds, and we get the opportunity to work with them even before the point of investment entry. So what we do a lot of is to work very closely with the companies that we're interested in to develop business development opportunities for them. And through that process, understand the company, understand the technology and the product proposition, and have the opportunity also to do diligence on how the market responds to the company's offerings. And through there, we gain investment conviction, and we're able to make a much faster and more decisive investment decision when the growth round does materialize. And we've done that for 4 of the portfolio companies indicated here, with multiple examples of corporates that we managed to introduce even before we invested our first dollar. On this slide, this is the management and investment team at Vertex Growth. Without going into detail due to time, there's more than 70 years of combined investment experience as well as operational experience and entrepreneurial experience as well. The growth fund is not fundraising currently, but we expect to come out to the market for fund 2 in the second half of 2021. And with that, I end my presentation. Thank you.
Okay, James, thank you very much. As a reminder, anyone with questions, please use the Q&A feature in Zoom and let us know who your question is for. And next, I'd like to move on to Algebris Investments. Okay, so Algebris, I believe your mic is off. Okay. Oh, there we go. Okay, we can hear you.
Thank you for giving me the opportunity to speak today, and apologies for the access issues we had earlier. This is Yoichi Nakamura, CEO of Algebris Investments KK. So today, let me introduce our company and what we do in Japan. Can you move on to page 2? Algebris is a global investment manager with a historical focus on the financial sector across the capital structure. So we are unique in a sense that we heavily focus on investing in financials. We invest both in financial equity and financial credit. And Algebris was founded in 2006 in London. And we have 14 years of track record with 13 billions of AUM globally. We have 8 offices in 3 continents. And our Tokyo office was founded in 2018. So this is our 3rd year here. And we started in a shared office back then. Now we have the license. We have people and some clients now. And with the great support of Tokyo Metropolitan Government, we have licenses in 2019, and we started marketing to Japanese clients since then. And so our targets are mainly to corporate pension fund in Japan, as well as financial institutions and distributors. And in 2020, this year, we have 2 mandates from corporate pension fund. And we also found distributors who distributed our offshore funds in Japan. So we are making progresses, and we see more opportunities in next year, 2021. So can you move on to next slide? This is a list of strategies we have at Algebris. On your left, you see financial equity. We have long only and long short financial equities, and we are running this strategy since 2006, beginning of our company. And our flagship strategy is financial credit with the AUM of about 10 billion euro. We are one of the largest investor in European banks, especially in financial hybrid area. From financial credit, we also have both, long-only credit as well as long-short strategies. Next is private debt. This is non-performing loans in Italy, targeting first lien mortgages, NPL portfolios secured by real estate assets. So, and this offers high expected return. And we also have credit, global credit. This is not 100% financials, but focus on sovereigns, financials, and some corporate debts. And we also have Italian securities. Next slide. We have about 130 people globally, of which 30 people are in investment team. Most of them are located in London and Milan, where investment teams are. Next slide, page 5. This slide shows global fixed income market by yield bucket. As you can see, only less than like 10% of the fixed income market yielding like 3% or more, and about a quarter of the market is yielding negative. So given this very hard to find the yield environment, we offer 3 income products, namely Algebris Global Credit Opportunities that yield 6%, Algebris Financial Credit yielding 5.3%, and Algebris IG Financial Credit Fund, it's yielding 3.2%. And the difference between financial credit and the IG financial credit is, as name suggests, IG financial credit invests in investment grade fixed income of the financial, mainly in banking. And we find many investors nowadays focusing on investing equities, but there are a lot of investors who look for modest income, modest yield, and many of like Japanese pension fund and some like retail investors want to have income products. So that's where we are good at, and we can offer something to these investors, clients, distributors. That's all for me. Thank you.
Okay, thank you very much for your presentation, and thank you to all of our companies that presented today. And we'd like to move into the Q&A session. So I'll be selecting the questions, and I'll be posing these to the companies that just presented. So the first question is to Hosking, Hosking Partners. So why do you narrow down your portfolio? Do you have any merits or strengths?
Sorry, I'm having some issues. I'm afraid I don't really understand the question, and I did send a private reply. If the person could perhaps send the question in again, I would be very grateful, because we have 5 sub-portfolios managed by our autonomous portfolio managers, which are then combined to form one big portfolio which has over 400 equities in it. The second part of the question is a little bit easier. What we consider our strengths to be are the multi-counselor approach, which allows us to look at the world in a much more holistic way than we believe managers who are structured more on regional or sectoral lines are able to do. We think our long holding period also gives us the ability to buy completely different shares from people who are perhaps looking at shorter term opportunities. And the benefit, we believe, for the end client is that we are decidedly different, and we are highly complementary to more traditional managers who might be in bigger cap quality stocks because their portfolios are more concentrated than ours. And I hope that answers the question.
Yeah, I think the first part of the question was asking about I believe it was slide 3 in your presentation of it showed a graph of over time, the number of portfolio companies being reduced, or the number of stocks being reduced.
3.
Yeah.
Three.
So I think the question.
Sorry, that actually, maybe I didn't explain it terribly well. That is the industry, and that is a sample of global equity managers off the eVestment database. So I think there are a couple of hundred global equity managers, and this is the trend that you see on the whole of global equity managers wherever they occur in the world, that over time they've been under pressure because they have been underperforming passive for such a long time. And the industry's response has been to get their active share up, and the way they've done that is by moving to more and more concentrated portfolios, where actually we have a very, very diversified portfolio, which allows us to do things very differently from the direction that the industry has moved in. Sorry about that.
Okay, no, I think that answers the question. Thank you very much. Okay, so the next question is for Vertex. The question is, how do you find your investment opportunities? Do you have any kind of unique network, et cetera?
I'm sorry, my line froze up for a while. Can you repeat the question?
Sure. How do you find your investment opportunities? Do you have some type of unique network or something?
Yes. So Vertex belongs to the Vertex group of funds. And as mentioned earlier, 80% of our fund is actually focused on investing in the follow-on opportunities from the portfolio of our sister funds. And just to recap, we have 5 early stage funds on the platform. 4 are technology focused, and they are geographically distributed across US, Israel, Southeast Asia, India as a region, as well as China. And we have a 5th fund that invests in early stage healthcare opportunities in biotech as well as medtech. And we have 20% of the fund allocated for non-Vertex deals. And while we are not systematic in terms of mining for deals outside of the Vertex pipeline, we have that flexibility to do so. And the reason why we're not doing that systematically is because the Vertex pipeline has been a really rich source of deals. And there are over 200 active portfolio companies, and we have distinct advantages in terms of being able to understand the portfolio companies deeply and much earlier. So giving us that investment advantage when the growth fund opportunity arrives.
All right, thank you very much for your response. So that's all for the questions today, and this will conclude the pitch part of our event as well. So here's the contact information for all of our presenters today. And this material will be made available to anyone who answers the survey that we just sent a link in the chat to the survey. So we ask that you please fill this out for us. And the link, again, to the material will be sent to all who fill this out for us. So again, thank you all so much for your time today. And this is the last event for the year. So we want to thank everyone for their participation and for their time. And we look forward to seeing you in Tokyo. Thank you very much.
Thank you.
Thank you. Bye-bye.